Biggest piece. That's how we get so many offers fast. Underwriting spreadsheet, I know it can look complicated, but we'll run through it pretty quickly, okay? And by the way, anytime you ask any questions on the underwriting training during the live calls that we have that pick up again next week, anytime you ask about underwriting, I use this spreadsheet. So it's always going to be the same exact spreadsheet every single time. Top left-hand corner, it's all about price and when you're coming to the closing table. So purchase price on this property right now is $2,075,000 is the exact number that I'm working on. I'm having to renegotiate a little bit. Due diligence, legal, civil, this is sort of just like, if you think about in a residential lens, it's sort of saying your attorney fees, your inspection fees, anything that goes into, getting the quote, final documentations or certifications to close. That's what this is. Okay. Syndication is basically how much money you'd like to make, because this is based off of a syndication spreadsheet. So syndications are where you raise money to acquire the deal. The syndicator, the person who's the GP, the general partner of the deal, makes 30%. The limited partners make 70%. And the syndicator also gets to make a fee. I was thinking about raising money and doing the deal. Probably not anymore. I'll probably end up just flipping it for $100,000. Closing costs. This is for mainly based on the fact of debt costs. Okay, so with commercial loans, similar to residential sometimes, where think about more like hard money in the residential world, right? Where it costs money to close, right? Like sometimes you have to pay a point, 2 points, 3 points, other recording fees, title fees, everything like that. That's this. And then obviously it tells you my down payment. So my down payment plus all my ancillary costs, I am coming to the table with $618,000 to close. This is now all about the loan. Obviously, interest rates in Canada probably slightly different than what we have here in America, so you'll have to kind of plug that ratio in. Obviously, I'm dealing with only the deals in the United States, so right now we're probably 6.5% to 7% right now, pretty comfortably, depending on the asset. Terms in years, so you can either do a 25-year term in America or a 30-year. Might be slightly different in Canada. You don't ever have to change the start quarter. It's always going to be 1. LTP stands for loan to purchase, similar to like loan to value, right? You're just going to put in whatever percentage rate you're going to have for a loan. In America, it's very common to get 25% down deals or 75% LTVs. Maybe, when interest rates kind of spike, you might end up being closer to 65 or 70. Long story short, it really has to do with this number. This is a magic number. This number here is called debt service coverage ratio. This has to do with at a 1, okay, at a flat 1, I know it says 1.334, but at a 1 means that my debt cost is the same as my income. Does that make sense?
Yeah, that makes sense. Yeah.
Right. So in this case, you obviously, to have a lot of cash flow, you want to have this debt service coverage ratio be as high as possible, right? However, in America, you can only get a loan if it's above 1.25, 1.3. 1.3 is for really industrial or retail, and multifamily is about 1.25. So this would be tight, as you can see it right now. 1.334 means you're going to be making very minimal cash flow, which you can see down here. I already have it auto-calculated. My cash flow year 1 is going to be a 6.5% rate of return on my money. But that gives you a quick breakdown. So, and then obviously type, you have amortization or IO, which is interest only. Does this make sense so far?
Yeah, it makes sense. Yeah.
Is this too basic for you, or are we going?
No, it's pretty basic. Yeah.
No worries.
Yeah, no, I think a bigger thing with industrial was like in terms of like cost per square footage or how to analyze when it comes to comparables, I guess.
Okay, cool. Yeah, so obviously this is the more complicated side, but down here you'll see things that really, really matter when you're underwriting a deal. When it comes to commercial real estate, unlike residential real estate, I don't just look at a property that. It's not about just purchase price, right? Like I like to go, it's straight to price per square foot. So if you see 2 identical warehouses, one, let's just say they're both 20,000 square feet and they both, one just sold for $2 million and you're like, you just got another 20,000 square foot warehouse and you're like, oh, $100 a square foot. This should sell for $100 a square foot. First off, the assumption can be completely off or it can be completely spot on based on a few other factors that are very important. One, cap rate is also a very important factor. So like if you're going to buy for, let's just say, a very high price per square foot, you might have a very good cap rate, right? You might have a higher cap rate, like a cap rate of an 8+ in a good location would be very good, right?
Okay, yeah, that makes sense.
But if you have a deal where hypothetically you're paying $100 a square foot, let's just say market value, but the cap rate is very low, like that wouldn't make any sense. So like, let me give you an example. This deal here, like, well, just pay attention to these two numbers. So an 8% cap rate, 130 per square foot, because what it's going to show you here when you see stabilized yield or stabilized sale or stabilized per square foot, what this is going to show you is that this is saying that this is my highest, like what it's going to be worth once I'm done with it. Okay. Like it is saying my implied value, market value in 20 quarters or 5 years at a resale value of a 7.5 cap. I'm going to sell this building at a $2.5 million value. So if the seller goes, hey, Henry, I want to sell my building for $2.5 million, that might be $25 million. My price per square foot, you might go, oh, but Henry, it's only $150 a square foot, $156 a foot. It could be a great deal. I'm like, well, it's only a 6.73 cap, and the highest I'm going to be able to sell it for in the future is the same price.
Okay, yeah, that makes sense.
So my returns, right, like the internal rate of return, which is going to be the most important factor when you're looking about investment real estate, it's not just about cash flow. I mean, cash flow is very important. But you can see here that my internal rate of return, which is the rate of return on my money over time. Essentially, you know how people say like the stock market is average an 8 or 9% rate of return? This deal would average a 5.25% rate of return annually, which is not exactly spectacular. And that's obviously with still a lot of risk. You can also see here that my cash on cash return year one would only be 2%. Who the heck would invest in something to make 2% on their money? Keep that, like, when I'm looking at this deal, I know obviously this is more fundamental, but this here really tells me if I'm going to do the deal or not. So my ideal is that when I'm plugging in all these numbers, which obviously like, you have like the, you'll plug in all the income on this page here. This is a single tenant, 16,000 square foot building paying $12. Originally it was 100% triple net, and now they're fighting me and wanting to only pay double net, which completely screws up the whole deal because they also asked me to pay $375,000 more than I was originally willing to pay. Long story short, it's obviously become a little bit more of a tough deal. So you'll plug in all the details, all the tenants' information, their square footage, how many units. Typically it'll just be one for each. It'll total everything for you. You'll plug in the price per square foot that they're paying. You'll plug in here if they're paying any reimbursements. I just have a calculation here, if you're good with spreadsheets, that they're reimbursing $4.50 per square foot. And then it'll total everything up. In this quadrant here, you'll put in the pro forma, which is like, okay, well, let's just say they're paying $12 a foot right now, but it could be $16 a foot. So I'd put 16 here. And then quarter to market is saying, when can they pay $16 a foot? I'm going to say, well, they can probably pay it when their lease is over, right? Let's say they're in a 3-year lease. Then you do 12 quarters, right? 4 times 12. So it's quarter to market. Just because when you're, doing these types of deals, you like to do it on a quarterly basis. So you can plug this in and it'll make an adjustment in 12 quarters. You can see here that this is where it made the adjustment, right? Which you can obviously see that it was already increasing by 3% a year. It was actually even higher than where we were going to be anyways, which is kind of strange. But anyway.
Okay. And that I guess is where you get your projected cap rate for...
Correct. Yeah. So actually this is not including this, so this would have to be like 20. But yeah, so then what you can do is that this, by plugging in different numbers of like what you believe the future value was, this will change the implied future value. Okay. You know how everyone talked about, like you just brought up pro forma, right? It's a very, very, it's like a buzzword. Keep in mind, pro forma in my life means nothing. Like it's very important for sure. And I care about today, right? Like I want to know, like, am I buying you make money on the buy, not on the sale, right? Mm-hmm. So it's like my purchase, I know could be worth in the future 3.285, 8 whatever, okay? Just because I'm buying it for $2.5 million doesn't mean that I'm getting a spectacular deal. I want to know, like, okay, my ideal numbers for these two is that, by the way, this is for limited partner returns. This is overall deal returns. So if I'm buying it myself, I look here. If I'm raising money, I'll look here. But long story short, I want to be like, I offered 1.7 million to start on this deal, which would have been a fantastic opportunity, and for a number of reasons. Obviously, you'll see the expense page. You'll plug in all the expenses. You want to make sure you have a column, an item for everything. I just lumped in the landscaping and snow together. This triple net tenant is actually paying their own, gas, electric, all that kind of stuff. So it didn't really matter what I put here. It'll total, and then for industrial, it'll total the price per square foot. But this is also, have you heard of the word CAM?
No, I haven't.
Okay, so CAM charges are basically a lumped up word for expenses. So it's saying like if the landlord, let's say you and I own a building together, okay? And this building right now costs us $100,000 a year to operate. Obviously in this $100,000, that includes not only utilities, property taxes, insurance, all the whole thing, but it also includes maintenance and it also includes repairs. We're estimating repairs in that. So technically, it didn't really cost us 100. It maybe cost us 100 minus, call it 25K to really, run the building. This is just a miscellaneous placeholder, and this is also, our fee, right? So sometimes tenants, if it's triple net, they'll pay everything, right? They'll pay repair costs and they'll pay management fees sometimes, but not always 100% of the time. long story short, what I'm saying is like, let's just say it's 75K minus, it's 100K minus the repairs and management. What you would do is that you could then go back to the income statement here and say like, okay, well, triple net means that they are paying 100% of the cost. Triple net is they are paying, like the landlord, if the rent is, let's just call it 100, in this case, 192,000 triple net or $16,000 a month triple net. That means I, the landlord, or us, the landlord, will net $192,000 at the end of the year. Our net taxable on this building per se, right, after all of our expenses drop to the bottom line, will be 192 grand. They are paying 100% of the expenses. Now, there is some instances where they're not paying 100% of the expenses. Sometimes it's $12 gross plus CAM. So CAM would be, let's just call it, I estimated $4.50 per square foot. You can see up here in the formula, I estimated a chargeback of $4.50 per square foot. So they're going to pay $12 base plus $4.50 per square foot for CAM charges, which means a bundle of the expenses put together. And I'm charging back that tenant every month. So they're going to pay me the $12 triple net, which is $16K, and then they're going to cut me a check for a separate $6,000 a month for separate expenses or CAM charges.
Okay, yeah, that makes sense.
Cool. So now the goal here is that obviously when we're looking at investment in real estate is that we want to make the most money on our money as fast as possible. Long story short, there's only so many ways that you can make more money in real estate. Number one is lower, it might sound rudimentary, but when we're thinking about these types of deals, this is how you can think creatively. One, obviously lower the purchase price. You want to increase the returns on investment. If we go from 1.7 to 1.5, we're going to then increase their internal rate of return. Okay, now let's go back to 1.7. Next. What do you think is another way that you can increase the rate of return on a deal if it's not lowering the purchase price?
Negotiating what a tenant's paying or vacant
Okay, hold on.
possession.
We'll pause there, right? So like increase the income, right? I agree with you. So you go to income, and let's just say that instead of $12 triple net day one, they're paying, let's just say 14. I'll just leave that here for the sake of this conversation. Yes, right? It would go up. I agree with you 100%. What else could you do? So you can lower the purchase price. You can increase the income. What can you do?
Vacant possession, but I guess that's the same conversation as increasing revenue. I mean, VTB would make it more attractive. I don't know if that would increase the returning. VTB, vendor take back.
A vendor take back for what?
For like seller financing. I don't know that would increase the return. It would increase cash on cash.
Yeah, so hold on. What you're actually saying is the debt cost. So debt cost could be different, right? You're saying the seller taking a note?
Correct, yeah.
Yeah, exactly. Right, so exactly what I was thinking. The debt cost is also a factor. So if we could hypothetically get let's just say the seller to hold a note at 4% interest only and only do 20% down, all of a sudden the interest rate, this internal rate of return continues to skyrocket. Mm-hmm. Those are the three biggest things that you can manipulate in a deal. It's either purchase price and having that obviously negotiate purchase price lower, increase the income before closing, or lower my debt cost. Sure, you can also argue expenses, right? Like, cut expenses, but that's very rare. And most of the time, a property owner, when they're discussing expenses with you, are actually going to underestimate expenses, not overestimate, right?
Okay. And then for the most part, when you're analyzing the deal itself, so it's my understanding it's based on, for warehouses at least, price per square foot, as well as cap rate on the front end of the analysis. Is that correct?
So, yes. So what we would like... Okay, let's say you and I are investment partners. If we just talk about what we would like, which means what will easily sell in the future, right? Because if we would buy it, then most people would. Okay, is below market price per square foot, right? So number one, below basis. Basis is price per square foot, right? Like if you're thinking about houses for a second, if the market value for houses in a neighborhood is $1 million and we can buy it for 700, that is below basis. You just don't think about it as price per square foot so much in the residential world, right? Obviously, if you're in Manhattan, you might think of price per square foot for condos, right? Or in Toronto, right? You might think of price per square foot for condos, or right? But for industrial or even commercial in general, right? Anything basic, multifamily is price per unit. Retail and office and industrial is price per square foot. So we want below basis. So if market value, if you go to CoStar and you do a report and you say, oh, industrial is selling for X price per square foot, call it $300 a foot in your market, $300 a foot, and you find something for $250 or $200, you're on the right track. Does not mean it's a great deal, but you're on the right track. I would rather us buy a deal that is a $200 price per square foot property, but a 4 cap, versus paying a $300 a square foot 7 cap. Does that make sense?
Okay, yeah, that makes sense. So price per square foot first, cap rate second, I guess.
Exactly. Yes, but both are drastically important because you can't just because it's like if it's $300 a foot in your market, you find something for $250. It doesn't mean it's a great deal. Hypothetically, they might need $1 million worth of renovations. It might be completely occupied and have long-term leases on it, and you won't be able to increase the rents for 15 years. Yeah, sure, I'm getting a decent price per square foot, but that's not telling the whole story. So it's first price per square foot, then it's cap rate, and then it's a clear path to value add, okay? A clear value add component. And you must be able to do it quickly and affordably. Where most people are like, oh, well, you can increase the value of this warehouse because you can build an extra 50,000 square feet on it. Okay, well, how much is that going to cost? It's like, oh, well, it's going to cost you $10 million. Okay, well, then what it's going to be worth afterwards? Well, it's probably going to only add $10 million more worth of value. Okay, then what the fuck is the point of doing that, right? It's a net zero. It's price per square foot first. Oh, so when you're now looking at comps, what you want to be paying attention to in residential, it's obviously house sales. You're going to be looking at similar houses. In industrial, you're going to be looking at similar properties that sold for an X price per square foot and what cap rate they traded, because both are drastically important. I think, let me just go back to our note here. So I think we're pretty comfortable on the industrial underwriting. Best practices to go for me being a principal purchaser, pivoting to having a buyer for the deal. Okay. You feel okay with the industrial part? What I want you to know, or for the underwriting part, because when you have a deal, by the way, you can bring it to me and we can talk about it. Okay.
Okay. Yeah, that makes sense.
So every Thursday on the underwriting training, just go like, hey, I got a property, 123 Main Street. Here's the details, 20,000 square feet. Here's the income. Here's the expenses. Or you can even just take this spreadsheet. This is your spreadsheet. Edit it. Do whatever you want with it. And you can make copy. I would just tell you to make 1,000 copies of it and keep going. And look, I'm telling you, like I've underwritten thousands of properties and I still talk with my investment partners that I do deals with all the time. And I'm like, hey, can you look this over for me? Right? Like, did I miss anything? Did anything look weird or messed up? So just keep in mind, like, just do it 100 times. Just like, going into residential, you got to comp properties a bunch of times before you just pick it up like nothing, right? All right, next part is practice from being a principal purchaser to pivoting. So what I like to do is that, let's just say this deal came across my plate. I'm going to go backwards a little bit because let me just clean up the deal real fast. It was 12 a foot. I made an offer at these terms. And let's get rid of that because I don't need it. Let's go here, 6.5, 7. Okay, this all looks good. So, anyways, this is what I offered the guy. Okay, I offered him originally a $1.7 million offer. Okay, I knew my debt cost was going to be this. I was going to have a 11 cap day one. By the way, this is a sale leaseback situation. I was buying it for a little over $100 a square foot. Fantastic deal, by the way, price per square foot wise. Overall, my debt coverage ratio was so good that my cash on cash return, day one, year one was going to be 18% nearly. Okay.
Holy shit.
So overall, this was going to be a wonderful deal. This is what I offered originally, which by the way was also if you go to income, I offered a $12 per square foot, 100% triple net, so tenant covers every bit of cost. Now, a couple things happened. It took us, by the way, I offered this 6-8 months ago, something like that. Dragged his feet. He's like, look, I'm going to sell it to you, but just like give me time. I'm trying to deal with X, Y, and Z. He's handling a trust, blah, blah, blah. Okay. Anyways, they finally come back and they go, listen, we talked to a realtor and we want $2.5 million. We ended up settling at $2,075,000. I was able to negotiate more. I came up $375,000. Wasn't happy about it, but still numbers penciled out. It was still a 9.5 cap plus day one. Still my internal rate of return was near 30. Overall, still the deal made sense numbers wise. And I had a 1031 exchange. I was still going to cash flow the year one at 11.5% on my money. Long story short, I was okay with it. Now, the tenant came in and said, hey, because by the way, I wrote up a letter of intent for 1.7. I then changed my letter of intent as the principal purchaser for $2,075,000. And we agreed at $2,075,000 given the triple net situation. Tenant was going to pay 100% of the expenses. The tenant then comes back to us and says, hey, I'm not going to pay 100% of the expenses. I only want to pay a portion of the expenses, which now drops this down to $4.50, which is where we were when we started this spreadsheet, which brings down my returns drastically down. I'm making 6.5% of my money, 15% a year, or not like all of a sudden this deal is like nowhere near as good of a deal as once it was. So now it doesn't make any sense for me, you, us, as an example, to purchase this deal. Okay. This is not that good of a deal for us to buy it, but it could be a good deal for us to broker it or wholesale it. Knowing that we need to be at $2,075,000, which by the way, I'm working on renegotiating now because I'm like, you just took an extra 25K or 30K in profit net to me annually, and you took it away from me. So I'm like, I can't just pay the same price. Anyways, I'm working on renegotiating it, but let's just say we're at 2 million. Let's say we negotiated back down to $2 million. Okay, just for a number's sake. Let's say we negotiated down to 2 million. I could then go to an investor or a buyer in my marketplace. You can do a little radius search, see who's bought industrial properties in the same town, in that same marketplace, similar type of property, in and around this price. Obviously, you don't want to be calling people who own the last properties that they bought were $1 million. I'd rather call people who've bought more expensive stuff to buy a cheaper property than people who've bought not as expensive stuff to buy the most expensive property they've ever bought. So long story short, though, is that now we have choice. You and I are like, oh, okay, they're willing to take $2 million. The deal is still not horrible, but it's not such a good deal that you and I would buy this deal. So what I would do is I would go out to the market and go and try to pitch it at $2.2 million. Okay. Knowing I'm probably going to get a little bit less than that. Okay. Maybe you can pitch it at I'm trying to see what an 8, see we're at 7.64 cap. Let's see if we can go down to 215, whatever. We make $100,000. Okay. There's an 8 cap almost on the dot. So we go out to the market. We could probably sell it at an 8 cap today, day one. We know we can, we know that we are at 2 million. We're going to sell for 2.1. We go out to the marketplace, we find a buyer, and we can renegotiate and say, like, listen, one of our partners this is why I've said this 1,000 times. One of my partners actually just wants to buy it. And what I'll do is that I'm going to charge him the commission. So it'll technically say seller's paying the commission, but he's going to pay 2.1. You agree to 2 million, he'll pay the 100,000. And we just basically set up a broker fee. Okay.
Okay. Yeah, makes sense.
Right. And we've done that 100 times. Now, don't get me wrong. I would flip it to a broker fee in this situation because it's only $100K. Now, as an example, if I had it locked for 1.7 and for one reason or another, I was like, hey, I don't want to buy it, which would be kind of silly. But if let's just say I was in a cash position where I couldn't make sense of acquiring it, right? I didn't want to put down the 5.25 to buy it. I could be like, oh, well, what could I sell it for? I could probably sell it for 2 million all day long. Right. So then I could wholesale it for 300,000. Now, because the fee is so sizable, and I probably don't want somebody seeing that we're going to make $300,000, we're probably double closed. So I'll go into contract. I'll put down a $10,000 or $25,000 deposit. My buyer will do the same thing, but he'll go in contract with me to him, right? Very similar to residential wholesaling. We'll go through a due diligence period. Everything will work out. Let's say he wants a $50,000 credit. I'll lead $50K. Instead of making 300, I'll make 250. Minus closing costs and everything else, we'll probably end up with like 200. But 200 is obviously still more than a $100,000 broker fee.
And let's say, like in an example where, let's say you offered them the 1.7 with your own corporation or LLC on the LOI.
Yep.
And they came and they accepted that 1.7. And even, I guess you could still do the same. Even if you weren't able to close on it and you had no intention of actually purchasing it yourself, You could probably just say the same thing that you just said. Yeah.
So I want you to keep in mind. So like my mindset is traditional corporate commercial real estate. Okay, is basically generate an opportunity, right? Somebody wants to sell their property. Get them to agree to listing the property at X price, right? Agreeing to sell a property at X price. Getting them to sign a bunch of documents. You still haven't talked to a buyer yet, okay? Like you've spent weeks now getting them to, find this lead, meeting with them, getting to sign all the documents, and you finally put it on the market, okay? Which it's probably overpriced. Most of the stuff that you ever see online that's listed for sale is overpriced, right? The best deals are always done off market. And you're like, why is it not selling, right? Like all of a sudden 3 weeks later of listing it, you maybe got one offer. Let's say that we got this guy wanted $2.5 million, right? He spoke to a realtor, wanted 2.5. I keep doing 25 million. What's $2.5 million? And you're like, I don't know why it's not selling. It's not, the best offer I got is $2 million, right? On this deal. Everyone keeps offering 2 million, 2.1, 2 million, 2.1. So what I do is that I'm like, okay, if I just know every single person's probably going to offer 2 million to 2.1 on this property because numbers are just numbers. If you know how to read a P&L and understand how to evaluate property, just like a residential property, if you already know that this market, this neighborhood trades for $1 million or so, in this world, why would I not just make an offer for 1.7 or 1.8? Because if he's willing to take that, I know we can make money. Instead of waiting weeks, if not months, to be told the same thing. I just do that in one day. So every time we generate a lead, my team and I, we write up, 50 offers a day and we submit, these letters of intent with my name on it. Now, don't get me wrong. The way it works with me is that they find the lead, they bring it to me. I let them know what price they want that I feel comfortable with, or they come to me with a price and I make corrections when necessary. They write it in my LLC and they're the broker on the deal. Now, the owner doesn't know that I'm also getting paid on the broker fee if they were to accept it, but I'm technically a random buyer, right? Or the 1031 exchange buyer. A little bit different of a situation if you obviously don't have a team. I know you have a team, but like if you're just prospecting for yourself and having to put in LOI, which I do for myself, by the way, I'll still write up LOIs in my own name. I just don't also take a broker fee. It's one or the other. I'm either gonna acquire it or I'm gonna take a broker fee. It's not both.
So would you just put an assignment clause in the LOI or say like address that there may be an assignment clause in the actual APS?
Yes, it
If
does
let's
say
say
it says in the LOI, it says that it's and or an assignable LLC.
Cool, makes sense. Okay.
Yeah. And just keep in mind that like there are going to be some terms that you say that I have no idea what you mean just because of the, cross
Canada, yeah.
Yeah. So but I obviously there's the exact like kind here. I just might need a minute to understand. Like, because we call them PSAs here and you have a different word for your contracts.
I mean, PSA sounds like it makes more sense, to be honest.
Because you call them
APS.
APS.
APS. Yeah, agreement of purchase and sale. Yeah.
Yeah, we just call them PSAs, purchase and sale agreement. Same exact thing. But I'm just saying, like, just give me a second if I'm wondering. Cool. Do you have any other specific questions about this kind of facet?
No, that's pretty much it. So basically, you would put an assignment clause just in case if they do accept the LOI. Like, let's say if you send out 50, you said in a day, where 10 or 20 accept it.
Which is never going to happen.
Yeah, even
if we send 50 a day, I might get one a week who accept my offer, like 1 to 250, because I'm that aggressive. Like, keep in mind that like this guy would in this reality here, I'm stealing the property at 1.7 million, right? Like it's like buying $1 million property for 500 grand, right?
Mm-hmm. Yeah, exactly.
Like not everyone's going to agree to it, but I want you to understand something. And I feel like people just this is a big misconception with the way we do business. I'm making an offer not that they accept it, but to start the negotiations today versus starting it in 6 weeks from now.
It's like wholesaling, kind of, yeah.
Exactly. I'm like, listen, but it's also like sitting down with a residential property owner and being like, listen, you're sitting at the table. Look, this was my listing pitch when I did residential and I was doing 100 sales a year. I sit down with them like, listen, we have 3 different options today. One, you can get an all cash offer for 600. We can list it on the market for 799, and you'll probably sell it in 30 days. If you're open to it and you really don't need to sell it, we can list it for 999, and maybe just maybe you'll sell it in 5 years. What would you prefer?
Easy enough.
Let them choose. I'm already putting numbers in front of them that shock the shit out of them, where it's like, okay, now I get to gauge where their head's at. There was some, very few were taking the cash offer right away, but a lot of people would go with more, the appropriate price in the center. But the point is, I'm already starting the negotiation process, right? Versus me wondering where their head's at, like, and just saying, oh, they want to list it for $1 million, so I'm going to list it at $1 million, right?
Mm-hmm. Okay. So,
anyways, it's just in this philosophy, I'm not trying to take a listing. I want to negotiate with them day one, because a lot of people, when you call them up and say, hey, would you be open to selling? A lot of people will be like, yeah, sure, I'm open to selling, but they want $15 million for a $5 million property.
And even at that, now that I think about it, if you're sending an LOI as an example here for 1.7, where you're getting a stupid good deal, if you have all these equivalent analysis, let's say 50 LOIs, if anybody tries to come after you for the LOI, okay, well, I'm going to close for 1.7.
For sure. No, like, listen, the only thing that can go wrong is you offer too much. And by the way, an LOI has as much value as a napkin.
Yeah, exactly, yeah.
I could have wrote a napkin with 1.7 million on it and put my finger, my signature on it. Right? It's like whatever. And sure, twist my arm, I'll close for 1.7. And I still have due diligence. It's not like I'm a moron and putting zero due diligence. Like I'll always have due diligence on there.
Yeah, no, that makes sense. Yeah. And
also in my letter of intent, it still says contingent upon fully executed PSA.
So yeah, no, that makes sense.
Next part is scripting for sellers to get an NOI, like the true NOI numbers on the first phone call, not ballpark range. Numbers go back and forth via email. Yeah, I get it. So keep in mind when you're dealing with this is something that everyone deals with. I deal with it. Every one of my agents deals with it. Everyone I coach deals with it. Like this is something that everyone will deal with. You will deal with it. I will deal with it forever. What I have found is that this happens from one of a few reasons. If someone's not giving you the true numbers, what is that immediately telling you?
Trust.
Well, number one, sure, I would argue trust as well. It's definitely a factor, right? No, sure. One, they don't trust you, which is fair because you're cold calling them out of the blue. So you have to build rapport and build trust. What would build trust fast?
Reputability. I'll let you go. What do you? Yeah. What?
Sending them a letter of intent.
Okay, easy enough.
Right? Like, yeah, like you want to provide. I want to make sure you're a real person, right? Like, like when you own a property, like we own several. If people call me up and say, "Hey, I want to buy your property," which we get all the freaking time, I'm like, "Sure, send me an offer." And I literally have offer memorandums, like all the information they could possibly need to make an offer, and I have a link to it, and I just send it to them, and I wait, and I just never hear back from people, right? So it's like I don't trust you, right? Like if you are saying you want to buy something, and I send you an offer, make me an offer of something. I don't care if it's half the freaking number. I don't care what it is, right? But make me an offer. That's how you build trust with me as an example, and that's how we found that it builds a lot of trust with sellers. But two, if someone is saying, well, I don't really want to give you any information, how motivated do they sound?
Not very motivated.
Not very motivated at all. Like if you are motivated to sell your property, you're going to give me information so that I can make you an offer. You're not going to just hold it against me right? That'd be weird. Like, just keep in mind that what too many people make the mistake of is believing that someone who says, it's just, it's like, if it was in the residential world, it would be mind-boggling, but because it's commercial, because no one knows how to evaluate commercial deals, everyone just hopes and prays. It's like a residential homeowner who goes, I want to list my property for $2 million, but I know it's only worth $1 million, but I want to list it for $2 million because I'm really not that interested in selling. But like every single time a commercial property owner goes, I want $2 million for their property, it's really worth $1 million. Every single commercial broker's like, no problem. I'm pretty sure I can get that for you. Let's list it on the market. I'm like, why the hell would you do that? Like, they're not motivated. They're not interested in selling. You're not going to sell it. It's going to sit on the market for 6 months, and then the guy's going to hate your guts. I'd rather just offer the guy 800 day one, engage him, right? And sometimes he's like, look, I'll take 1.2 if I know 2 million was a little bit high. I didn't know if you were real or not. I'll take I'll take 1.2. Like, oh, okay, this guy's not out of his freaking mind. When you're dealing with somebody, one, of course, build trust. Two, when you're speaking with them, it's like, listen, we can do this a few ways. If you provide me zero information, that's probably gonna result in an offer because I can make you an offer no matter what. An offer but it's gonna be an offer you're probably not going to like, right? It's like if you had a house and you said, hey, make me an offer, but I'm not gonna tell you my address. I'm not gonna tell you, when I bought it. I'm not gonna tell you the age of it. And I'm not gonna tell you any renovations on it. Make me an offer. What kind of offer do you think you're gonna receive? Well, probably a pretty low one, or probably just something that doesn't make any sense, right? Because we don't know what we're trying to buy. In this instance, I have your address. You and I both know that properties are valued based off of the income of the property. I'm not a developer. I don't plan on knocking this building down. I'm going to buy it for what it is. If you can provide me at least a ballpark rough estimate of what the property is currently generating in gross income, you always want to get gross, by the way. Get rid of the idea of that they're going to tell you an accurate NOI because it's bullshit. I'd rather you'd say the property generates roughly 10 grand a month. Great. I'll estimate 9 grand a month. I'll take a 60% net profit ratio. So 40% expense ratio. Roughly that's what I use here in the States. And I'll be like, okay, so your rough, I don't need to say this to them, but I can gauge their rough net operating income based off of my estimates is X. I don't ever want to say, oh, so what's your net income per year? No one's ever going to tell you that. Even if you called me on one of my properties, I wouldn't be able to tell you. I could say I cash flow roughly X amount of money, but that doesn't mean anything, right? Cash flow after debt payments and everything else, like, oh, I have a property that I cash flow 4 grand a month on, or this one I cash flow 15 grand a month on. It doesn't whatever. It doesn't that's only a small piece of the puzzle, and it doesn't tell me much. I'd rather you say that the property generates $400K a year, roughly 35, call it 33 to 35,000 a month. Okay, great, because then you can go back and do your calculations and estimate based off of our expense estimates a better NOI, actual true NOI, including management fees and repairs and vacancy rates and other things that they're probably not going to allocate for. Does that make sense?
Because they'll probably just go right up to like 80 or 90%.
Yeah, like they're going to be like, oh, well, I only pay for taxes and insurance. And you're like, okay, well, I can understand that. So that means the tenant pays for everything else? Like, okay, they pay for landscaping, they pay for this. Well, they don't pay for landscaping. Okay, got it. So what about snow? Oh, no, they don't pay for snow either. So I pay for taxes, insurance, landscaping, so that's it. I'm like, okay, well, they're also not including management. They're not including vacancy rates. They're not including repair budgets, right? So they're never going to tell you that, but we need to estimate for it. You know what I mean?
Okay. And do you do 40% as a rule of thumb for both industrial and for multifamily, or is it a bit
depending on the size of the deal? So if it's a much larger deal, yeah, 40 is pretty conservative. Now, Obviously, keep in mind that like our real estate taxes in the States, mainly in the areas that I work in, are pretty high. I don't know Canada's real estate taxes, right? I don't know your insurance costs, right? So I don't want to try to claim like I know that. Obviously, what I would tell you to do is say, what you can do is that you can take their estimated taxes, insurance, and all their costs that maybe you've gotten on other properties, and we can look at it together a few times, and I can get you kind of a rough number. But to be safe, 40-ish is probably fair,
Okay. Yeah, that makes sense.
Somewhere in that range. And next part here, scripting for buyers to properly position the deal. Being able to have a buyer look over the numbers with me on a call right then and there and weed out the tire kickers. Great. A couple things that come to mind. One is that you don't need thousands of buyers. You need a dozen really good qualified seasoned guys that are constantly buying 2, 3, 4, 5, 6, 8, 10 deals a year. That will make your career. You can make hundreds of thousands, if not millions of dollars a year with maybe a dozen guys. Speaking with thousands of buyers over the course of a year that 98% are just bullshit. Maybe they own nothing and they're like a first-time investor and they're trying to buy their first deal, and then they're like, oh, okay, these numbers make sense, and then you get through halfway through the deal and they don't have actually as much cash, or they start not making such assumptions that end up getting the deal killed, and you're like, what the hell just happened? So I like dealing with seasoned people. I don't like dealing with first-time investors. That's one. Two, this spreadsheet you can give to people, but keep in mind that this spreadsheet is not going to be the end-all be-all. This is going to give you understanding of how to pitch the deal. What you can give them is a copy of the income and expenses. I'm thinking I'm still sharing my screen. You can give them a copy of the income and expenses that you've broken down. You can be like, look, here's all the expenses that they gave me. Here's the rent roll. Here's the gross, the details of the leases. Because in industrial real estate, what you're actually buying is leases. You're buying the leases. That you're buying a contract to get income. Essentially, you work and operate out of a space that I provide you, and you are contractually obligated to pay me money, right? So I'm buying technically leases, the obligation of you to pay me. When you're talking to somebody and you don't have details about income, you don't have details about the leases, you don't know what kind of lease rates that they're on, you don't know what they're paying, you don't know what the terms are, you don't know if it's triple net or if it's gross plus CAM or just gross rent, right? Like you don't know how long the leases are, you don't know when they started, you don't know, how much space they take up. If you don't know those intricate details, it's very hard for somebody to give you an answer. You know what I mean? Hey, here's 0 ingredients to a cake. Make me a cake. How? When you're trying to get somebody to make you an offer, the more information you can provide them up front, specifically, by the way, when you're dealing with newer investors or even seasoned people. But like I have seasoned guys who as long as we have ballpark figures, we can make massive levels of assumptions. But obviously we'll still need, to actually have a contract, an executed purchase and sale agreement, we're going to need substantially more information. We can write up, like my team and I and my investors, I'll write up a letter of intent with bare bones information. I could be off and I'm open to being off. Right. But, we obviously still make very aggressive offers, but we can still make an offer with very minimal information. Keep in mind, most investors are not always like that, right? Like my mental philosophies and the people I work with are very seasoned guys. So like I could bring them a deal with very minimal information. We can make massive levels of assumptions and we can make an offer same day, same time. When most investors might be like, listen, John, like I need leases, I need a rent roll, I need the expenses. You got to give me something, right? I don't need all that. Most people will. So the more information you can collect up front will save you time, energy, and effort in bullshit conversations with buyers on the back end.
Okay. And then I guess at that point, it comes down to fishing out the deal to enough investors over time to where you start to find those serious guys that you kind of have in your Rolodex over time.
And the cool thing with CoStar is that it'll actually break down and be like, hey, here are the people who bought the most property in this area of this asset class. And you're like, oh, I just need to know these guys.
Okay. Yeah, that makes sense.
And I'd also ask questions to vet out the buyers. Be like, listen, when's the last time you bought something?
That's what I was just going to ask. Yeah.
What else do you own? How much cash on hand do you have right now? Right. Which basically gives you a budget. Because if they say I only have $1 million, like clarify, do you have $1 million to invest or you have $1 million total? Because you're not going to spend the full $1 million. Right. Because when they go like, oh, well, I'm looking for properties between 2 and 5 million. Like, okay, I can understand that. What kind of properties do you own right now? Well, I own a bunch of smaller multifamilies as an example. Everything, and they tell you like, oh, they're all worth between, X price and X price. Oh, like you said 2 to 5 million. So you don't own anything between that price range? No, but we're looking for our first larger deal. That person's probably gonna have a harder time making sense of a $4 million deal than going to somebody who owns a bunch of $4 million properties. So it's like, you can ask questions of like, what do you currently own? Where is it? Right. If they say like, I buy a lot of, like, what's a town 30 minutes away from Ontario?
We'll say from Toronto, Oshawa.
Okay, cool. So it's like, okay, you're talking to 2 different types of investors. One guy has stuff, so you're talking to 2 different investors and the guy goes, all right, yeah, I want to start buying in Ontario, right? And you're like, okay, that's awesome. So where do you own stuff right now? And you're like, well, most of my stuff's in Alberta. What do you mean you're going to buy in Ontario? Like, oh, well, I'm looking for my first investment here. That person's going to have a harder time making sense of a deal in your area versus somebody who owns stuff in your area. And most of the time we don't pay attention to those things. Even if it's 25 minutes away, it doesn't matter. Like, okay, well, let's just say 100% of their properties that they own 6 buildings, they're all in Ontario. Great. That'll be a good person to bring something in Ontario.
Okay. Yeah, that makes sense. All right. I'm just writing down as you're talking. Okay, cool. And then, so I guess, would you say like at the very beginning, so you send the deal via email to like a newer buyer that I'm just starting to work with and call it follow up once in a few days. And then
so what we do is that we'll do one. The only time we'll ever send out an email is in 2 different scenarios. One, it's an email blast to an entire marketplace, right? Like, so we have, like, let's say 300 buyers in a market that are all looking for X type of asset. We'll do an email blast to that email list. 2, we've been on, because like the way we pitch deals is that we call first to pitch the deal over the phone. I want to be on the phone with you pitching the deal. I don't want to ever send out an email to you and go, hey, what do you think? I want to be like, I'm calling you John because I know you, John, buy deals in X area, and I have a deal in X area that fits your criteria. And then they can go, well, send me some details. Great. Are you in front of a computer, John? Yes, I'm in front of a computer. I just sent you the email. Can you open it and let's review it on the phone, right?
Cool. Okay, I like
I'm
that.
not going to just send you an email and go, I'll call you tomorrow. Let me know what you think.
Okay. Yeah, I like that.
Never.
Cool.
Yeah. Are you in front of a computer? And they go, no. When will you be in front of a computer so you and I can discuss the deal? Or can you be on your phone right now and open your phone and put me on speakerphone and we can talk about the deal right now?
Cool. And then position it almost as like an over the phone.
Always over the phone. Always. You will that's how we get so many offers fast. Biggest piece. We never just send out an email and hope and pray. Never.